Leonberger. I'm the Director of Research here. There are a lot of familiar faces out here. Thank you for coming back to our symposium. For those of you here for the first time, we hope it's the first of many. I hate to be the bearer of bad news, but I'm going to lead with two small pieces of bad news. Number one, yes, we have a break scheduled. No, it's not going to be at 11 o'clock. We're running a little bit behind schedule, but I do promise you a break if you listen attentively to whatever I say. Point number two, you have to listen to an actuary for 20 minutes to get there. So we'll get there, but just keep your heads up, and I promise you won't be that boring. I'm here to answer one question. Is it time to reassess portfolio objectives? We'll circle back to why we're asking that question today, but first, just as a reminder for all of you out there, you should be familiar with how we build your portfolios. We certainly try to customize every portfolio to your circumstances, whether they be cash flow, liability, spending patterns, whatever it may be. But we think really, we lead with four main principles, or four main goals. Number one, asset growth. Everyone wants their assets to increase over time rather than decrease. Number two, mitigate risk. It's great to have growth in your portfolio, but if doing so creates this tremendous downside potential and range of outcomes with a lot of uncertainty, that's not the most comfortable spot to be for managing a portfolio. Spending and benefit payments. Just about every one of you out there, all your organizations have pledged support to something or someone. If you're a pension fund, it's those retirees who've worked their careers with your company and have earned that retirement benefit. If you're an endowment or foundation, it's dollars to support scholarships, grants, buildings, and many other needs. And last, certainly not least, when you need that money, you want it to be available. You don't want it all to be locked up in private equity and you can't get your money out of the markets, okay? Those are the four main principles. We optimize around those for each one of your return goals. So why are we asking this question today? Well, quite frankly, because we can ask this question. A little bit of background. I think all of you are probably really sick and tired of hearing about inflation higher, even higher. Well, I'll stop there. Nothing more needs to be said. And again, the next slide. Everyone knows the next slide too? What did the Federal Reserve do to address the inflation issue? Well, they increased interest rates. They increased interest rates 2 or 3 times more than what they were over the course of 18 months. A very quick run up in rates, okay? That has certainly had implications for capital markets. We saw it very painfully last year in 2022. It has been suggested, and I think it's probably a pretty easy argument to make, that if we hit a recession, it's mostly due because rates are a lot higher. But this has also had an impact on expected returns for capital markets. Now, equities, not so much. There's fairly consistent mean reversion to equities when we think about expected returns on a long-term basis. But fixed income, expected returns for fixed income are driven by 2 variables. Number one, interest rates. Number 2, credit spreads. Credit spreads are about at long-term averages, but we've just established, and we all know interest rates are a lot higher, so expected returns for fixed income, as shown here in that blue line, has moved up quite a bit. Now, just if you're wondering what the source of these numbers are, it's not me and a couple people on the asset allocation team just drawing numbers out of a hat, but we have an asset allocation software here, 30 pages long worth of details and programming. Trust me, you don't want to read it. But that generates all the expected returns we share with you. And all the asset allocation studies you've seen over time are driven by that model. Just wanted you to understand the source of those numbers. Okay, so fixed income returns are higher. Let's step away from fixed income versus equities for just a second and think broader picture, right? Building block. As we build portfolios, thinking about how you generate expected rate of return, a building block based on 3 numbers. Number 1, risk-free rate. Number 2, inflation. Then number 3, back into this market premium, right? You know inflation, you know risk-free. What else do I need out of the market to hit that target rate of return? Throughout this conversation, we are going to use a target rate of return of 7.5%. So let's rewind back to 2020. This conversation is really going to compare a model we built to hit a target rate of return in 2020, then the model we need to hit that same rate of return of 7.5% in today's numbers. In 2020, it was COVID. Fed enacted aggressive stimulus policies to keep companies afloat, consumers afloat, and to keep us out of a deep recession. The risk-free rate was 0, inflation was really low, 1.5%. We can all do some math, 7.5% minus 1.5%, 6% market premium. That's asking for a lot out of the rest of your portfolio, especially if you're very sensitive to volatility and downside risk. Now let's fast forward to 2023 and look at those same main variables. Well, our risk-free rate's now 4.2%. Inflation, 2.5%. That's an average number, okay? There's just too much volatility in inflation over the last 18 months to put a monthly number there. So that's a longer-term average. So market premium of 80 basis points, I think we can do that. Now, of course, that's not sustainable, but that's where we sit today as we talk about building block approach. Now let's get granular. Let's start to allocate to certain asset classes. Again, rewinding back to 2020, rates were so low, if you wanted to hit a 7.5% target rate of return, you could only have 10% in investment-grade fixed income. The rest we're going to call broadly risk assets, meaning by their very name, there was a lot of risk, a lot of downside risk. Here we are in 2023. We can triple that allocation to investment-grade fixed income, 10% to 30%. What does that do to the volatility? Well, the numbers are circled for you. That's a 25% drop in volatility. That seems like a pretty good trade-off if we want to hit 7.5%. But what this really does, and I started the conversation with this allows us to ask this question. Can we reassess portfolio objectives? It seems like today we can actually actively choose to have more return or less risk. 3 years ago, we couldn't do that. These target rates of return mean a lot to organizations. They mean a lot to how they conduct their valuations, meaning how much liability is in that pension fund, and they mean how much they can spend as an organization. So it's hard to drop that rates of return sometimes, especially in times of economic stress. So we have this 2020 model. I've already established that, right? It's going to be more risky. We need to have more risk in the portfolio to hit that target rate of return 3 years ago. Then we're also going to build this 2023 model. The changes are going to largely mirror what we just talked about. You're going to increase your allocation to fixed income, decrease your allocation to equities. So those are the two models. Now we want to build some test cases, okay? We have a lot of pension clients. We thought, let's examine this question against the context of a pension fund. And let's generate a pension fund that is relatively mature, 80% funded. We're going to say contributions are equal to benefit payments. There's going to be a zero net cash flow. 7.5% target rate of return, and we're not going to allocate to any illiquids here. It's going to be fully liquid. This is an analysis that can really be applied to any pension fund. And then let's do the same exercise for an endowment foundation plan. I will refer to that as E&F for the duration of this conversation. Same target rate of return, 5% spending ratio. That's a fairly common spend rate. And we will allocate to illiquids here because a lot of E&F portfolios do have an allocation to illiquid asset classes. Starting portfolio value for each one of these, $100 million. Now, some of you might be out there sitting, well, gee, I don't represent a pension fund. I don't represent an E&F fund. But the beauty of this analysis is that it can really be leveraged to any plan type. Because in one case, we're a zero net cash flow. Another case, we're spending a percentage of the portfolio. We're doing it with a $100 million base, so that can be prorated based upon your portfolio size. Again, designed to be a one-size-fits-all as much as possible. Let's start with pension funds. The first two boxes here, we're going to look at kind of four questions or four goals of this analysis. Asset growth, clearly, right? Next one, confidence intervals and range of outcomes. That's just an actuary's overly complicated way of saying volatility. Then full funding time frame. The goal of any pension fund is ultimately to be 100% funded, to have enough dollars in your portfolio to cover every last dollar of that liability until the pension fund is wound down. Then we will also ask the question, can we increase the target rate of return? Anyone familiar with how pension valuations are done for Taft-Hartley plans and public pension funds will know that the discount rate used to value the liabilities is the same as the expected rate of return on the portfolio. So if we can justify a higher rate of return, that means a higher discount rate. A higher discount rate, pricing actuarial liabilities is the same thing as pricing a bond. Higher discount rate, lower liabilities. Same asset growth means shorter time frame to being fully funded. First, the portfolios we're going to use. I don't need to go through this in a lot of detail. They're very similar to what we talked about a couple slides ago with the blocks of the different asset allocation, the allocations to different asset classes. 2020 model, 2023 model. I've circled the biggest differences. 20% to 40% fixed income. Then predictably, lower right-hand side of this chart, your volatility drops quite a bit. That risk-adjusted return, your Sharpe ratio, volatility down, Sharpe ratio up. That's a good trade. So let's look at asset growth and volatility on the same chart. The first thing we're going to talk about is projected asset value. That 2020 model, over the course of a 10-year forward-looking basis, grows to $222 million. That 2023 model, okay, we've taken risk off the table, grows to $209 million. A little bit smaller, 6% to be precise, but we can't talk about return in isolation. Let's talk about volatility. When we talk about volatility, we talk about its confidence intervals, right? The spread between that top 5th percentile, the bottom 5th percentile. The spread for that 2020 model is $326 million. Honestly, that's a pretty useless statistic just by itself. But if I compare that to the 2023 model, The spread is $227 million, 30% reduction. So here's the trade. 6% lower projected asset value, 30% lower volatility. I think to most investors, that's a pretty good trade. We also talked about the goal of pension funds is to be fully funded. So what is the path, what does the time frame look like for these different portfolios? Well, if we run that 2020 portfolio out, we're fully funded in year 7, okay? If we take that de-risked model, the 2023 model, that's fully funded in year 9. I asked the question, well, what if we can use that 2020 model, right? Using the asset allocation we set in 2020, using the June 30th, 2023 assumptions, that has an expected return of 8.1%. Can we use that to create an 8% discount rate or justify an 8% discount rate, which lowers the liabilities? Well, that shortens your fully funding time frame to 3 years. Where does this all leave us? Like any other investment decision, it's a risk versus return trade-off. Every committee, every group is going to have a little bit of a different conversation around this and arrive at their conclusion. Let's start by the fact that, yes, I just talked about you could increase the discount rate to 8%. Any of you out there who work on a pension fund are probably familiar with the fact your actuary has pushed to lower that rate over the last decade because rates have been so low, because the outlook for asset classes has been so low. I know all too well that actuaries are conservative by their very nature. It's hard to think an actuary today is going to be comfortable bumping that expected rate of return up. That conversation is probably a few years down the road. But as it relates to a mature fund that is relatively well-funded and not dramatically negative net cash flow month over month, year over year, we think trading a little bit of risk in strengthening that 7.5% target rate of return is a good exchange for a lot of plan sponsors to think about. That's pension. Now, we did this for 2 different plan types. Number one, so we could really cover as many clients as possible with this analysis, but also to ask the question, is the answer different based on different plan types? Pension plans at the end of the day are leached to that funded status and tend to have to make contributions at the most inopportune times. Markets are stressed, markets are dropping, economic times are tough. It's really hard to come up with cash in those types of environments to fund their pension fund. But what about endowment foundation plans? So we'll start with those same 2 kind of beginning analyses, right? Asset growth, confidence intervals, and range of outcomes. But then we're not going to talk about being fully funded. We're going to talk about that spending rate, right? And then perhaps can we increase that spending rate? After all, a lot of E&F plans or E&F organizations have tended to borrow money to fund some of their initiatives. Well, we've well established in this conversation as well as other ones, interest rates are 2 or 3 times higher. It's much more expensive to borrow money today. It was easy back in the day. You borrow money at 1%, invest it, earn 6%. That's a good trade. Today, that same exchange is not out there. Maybe it's a little bit better use of cash to spend a little bit more. We'll look at that. First, the portfolios. Again, very similar. The big differences here are we're allocating to real assets and private markets, 10% to each one of those. We're going to take 20% out of equities, flip it into bonds. Same dynamic in terms of what happens to risk and then risk-adjusted return. What does this mean for the numbers? We've charted this out for 3 different portfolios. The first one, again, that 2020 model, the one we created 3 years ago, but at today's return expectations, expected returns are higher. Then we've trimmed the risk on it to develop the 2023 model. Lower risk, your projected value is a bit lower, $127 million. Same trade-off essentially we saw for the pension exercise. But then what if we left the risk on the table but spent a bit more? Again, it's too expensive to borrow money or it's more expensive to borrow money. What if I just spent a little bit more out of the portfolio that's been growing over the years? So I really want to compare these last 2 boxes, right? $127 million, the volatility is a lot lower, or you spend an extra % 1 year. Yes, it's higher volatility, but your projected value, that median expected value, is pretty darn close to that 2023 de-risked model. That seems like a productive conversation to have for organizations that may need a little bit extra spending money today. Now, to kind of strengthen this conversation just a little bit, what about the available dollars to spend? Again, $100 million portfolio starting value, 5% let the risk run, that's $63 million over 10 years. Take the risk off the table, $60 million. And then leave the risk on, but then spend 6 instead of 5%. You get to $70 million. Okay, that's 10% more. That translates very easily to the extra 1% per year. What's the conclusion here? Well, number one, again, to repeat, endowment foundation plans are different than pension funds. They are not married to this funded status number. They are not subject to market volatility like pension funds are, meaning they have to put additional money into their plans at perhaps the most inopportune times. Historically, endowment foundation plans have been more aggressive with their asset allocation. They've allocated more to illiquids. They allocate more to risk assets. Because of that, we think this conversation here in the debate of reassessing portfolio objectives, perhaps spending a bit more, perhaps leaving a little bit more risk on the table rather than the de-risking, could be a productive conversation to have. The Wall Street Journal, CNBC, Financial Times, really any publication, cable channel that covers financial markets wouldn't exist if investors were prone to overreacting to the market. And this chart is here to show everyone that we're not here bringing this conversation today just because rates have risen so much in 18 months. But really, we think, if anything, this is maybe a little bit early to be asking this question, but we want to plant the seed really for this conversation later on down the road. With this as background, rates are going to stay higher. The Fed may very well cut a little bit in 2024. That's highly contingent upon recession, duration, magnitude, and if we even have one. But the expectation, and it's really been reiterated across the prior conversations, rates are going to settle at a higher level. This dynamic of fixed income returns being higher, there may be less of a give up in expected return versus equities, is something that should persist. We think the answer for pension funds, an exchange of risk for return, we think that makes a little bit more sense, meaning take a little bit of return potential off the portfolio to justify that expected rate of return, have a little bit more of a predictable path to being fully funded. Okay, again, that's really targeted towards well-funded, mature plans. We recognize every client is different, but broadly speaking, that's the takeaway. For endowment foundations, the opportunity is there to spend a bit more money. And this is not a uniform recommendation that all of you go back to your committees and say, we got to increase spending. We think it's a conversation that could bear more fruit today than it would have just 3 years ago. So that is the conclusion of my talk this morning. We're going to take a break. I have 11:10, so let's break for 10 minutes. We'll pick it back up at 11:20. For anyone who has questions for any of the prior speakers, we'll be up here during the break. Thank you.